All right, let's get right into it. Today we're taking a close look at the initial public offering for SSMD Agrotech India Limited. You might know them better by their brand, House of Manar. They're about to hit the public market, and we're going to break down what that could mean for you as an investor.
So, this is the big question, isn't it? Should you put your money into this IPO? Our goal here is to give you all the key information, pulled straight from the company's official documents, so you can start to form your own answer. Ready? Let's dive in. Here's our game plan for today. We'll kick things off with the IPO opportunity itself. Then, we'll get into the business and its interesting new direction. After that, we'll crunch the numbers, look at the risks, and finally, wrap it all up to help you make sense of it. Okay, let's start with part one, the IPO opportunity. What's actually on the table here? And, just as important, where are we getting all this info from? Let's take a look. First thing you need to know is our source. Everything we're talking about today comes from the company's Red Herring Prospectus, or the RHP. Just think of it as the official rulebook for the IPO. It's where the company has to, by law, lay all its cards on the table, the good, the bad, and the ugly.
So here are the key details you need to know. The company is SMD Agrotech, but they go by the brand House of Manar. They're doing what's called a 100% book-built issue, and they're going to be listed on the SME platform of the BSE. Now circle this date on your calendar. The issue closes on November 26, 2025. You don't want to miss that deadline if you're thinking about jumping in. Okay, now that we've got the IPO basics down, let's talk about the business itself. And this is where things get really fascinating, because they're making a big shift from a traditional business-to-business model to selling directly to consumers.
At its heart, House of Manar is a classic FMCG, or fast-moving consumer goods company. You know, they make and sell everyday staples, things like gram flour, dolls, spices. And for a long time, their main way of doing business has been B2B, selling their products to other businesses, not directly to folks like you and me.
But this is the real game changer. They are moving into a direct-to-consumer model with a super innovative idea they call a dark store factory. Picture this, a mini factory right inside a big apartment complex, making fresh flour and spices on demand. And their big promise? Delivery to your door in just 10 minutes. This is a huge piece of their whole growth story.
And that brings us perfectly to the section a lot of you have been waiting for, the growth plan and the financials. Why are they raising this money, and what do the profit numbers actually look like? This is where we get down to the brass tacks of whether this is a good investment.
Well, here's a huge clue. A massive chunk of the money they raised from this IPO, over 203 lakhs to be exact, is going straight into one thing, building out that network of D2C dark stores. They are absolutely betting the farm on this new model.
And they've got a clear roadmap. They're focusing on the Delhi and NCR region, planning to open 16 stores in total over the next couple of years. But check this out. This is the projection that should really catch your eye. They estimate that each one of these stores could pull in 4 to 5 lakhs in revenue every single month.
And when you look at their track record, you can see why they're optimistic. These numbers are, well, they're pretty incredible. Their revenue has more than doubled in just 2 years. But look at the EBITDA, which is a key measure of profitability. It has absolutely exploded. We're talking more than a 10-fold increase in that same period. This looks like a company that's really hitting its stride.
So how do they measure up against the competition? This is really telling. While we don't have their PE ratio just yet, look at the return on net worth. At 78%, it absolutely crushes its peers. That suggests they're incredibly efficient at using their money to generate profits. Plus, their revenue is already way bigger than these other listed companies.
Okay, the growth story is exciting. The numbers look great. But, every investment has a flip side. So let's be responsible and move on to the key risks you have to think about, as laid out by the company itself.
First, let's look at what the company considers its strong suits. They talk about their wide range of products, their experienced leadership, and their focus on quality. And of course, they're heavily promoting that innovative 10-minute delivery model and their growing brand recognition.
Now for the reality check. The prospectus is very clear about the potential downsides. The original founders, the promoters, will still have a huge amount of control, which can sometimes be a problem for smaller shareholders. The company doesn't own its factories, they're leased. They rely on a few key suppliers. And hey, it's a food business. There's always the risk of contamination, not to mention the cutthroat competition in the FMCG world.
So we've got the exciting growth story on one hand and the serious risks on the other. Now let's bring it all together into a framework to help you decide what to do.
It really boils down to this, doesn't it? This is the dilemma. On one side, you have this fantastic growth story, the booming profits, that cool D2C model, and a clear plan for the IPO money. But on the other side, you've got these red flags, the concentrated control, the reliance on leases and suppliers, and just how tough the FMCG market is. And hey, for anyone who's kind of new to IPOs, here's a quick practical tip. When you apply, you'll use a system called ASBA. It's great because your money doesn't actually leave your account. It just gets blocked. It's only taken out if you actually get a lot of the shares, which makes the whole process super safe and easy.
And so here we are back at the big question. But now you have a much clearer picture. The decision you have to make is this. Do you believe that this innovative D2C growth plan, backed by some really strong financials, is powerful enough to overcome the very real risks of a competitive market and concentrated owner control? That's what it all comes down to.